Listen, I want you to picture something real, not a hypothetical, not a headline. A real American couple sitting at a real kitchen table on a real morning. Tuesday, October 13th, 2026, 7:12 a.m., Sun City West, Arizona. James Cooper is 68 years old, a retired school administrator. His wife, Linda, is 66, a retired nurse. The coffee is brewing. The morning news is playing softly in the background. And sitting on the kitchen table is a framed photograph from a Yellowstone family vacation taken almost 20 years ago. Back when the kids were young, back when retirement still felt far away, back when James believed that if you worked hard, saved consistently, and followed the rules, retirement would be predictable. James did everything right. He contributed to retirement accounts for decades. He delayed Social Security. He paid off his mortgage. He avoided consumer debt. He built more than $1.3 million in retirement savings. Everything the experts told him to do. Everything. And now James is holding a notice from Medicare. His hands aren't shaking because he's scared. They're shaking because he's confused. The notice is polite, professional, almost friendly, but the message inside is anything but friendly. The government is informing James and Linda that their Medicare costs are increasing. Not because they committed fraud, not because they broke a rule, not because they suddenly became rich. Their costs are increasing because of a number they never knew mattered, a number hiding quietly inside their tax return, a number that crossed a line, and that line is about to cost them thousands of dollars. The increase over the next year? Approximately $4,728. Gone, just like that. For what? One income decision, one line on a tax return, one threshold they never saw coming. And here's what makes this story so dangerous. James and Linda aren't unusual. They aren't financial amateurs. They aren't reckless spenders. They're exactly the kind of retirees America tells you to become. Responsible, disciplined, prepared. Yet they still walk directly into this trap. Because nobody explained how the trap actually works. Nobody explained that earning a little more money in retirement can sometimes make retirement more expensive. Nobody explained that Medicare doesn't just care about your age, it cares about your income. And once your income crosses certain thresholds, a completely different set of rules can begin applying. Rules most retirees never study. Rules most financial media barely discusses. Rules that can quietly drain thousands of dollars from married couples who thought they were doing everything correctly. This is a crime scene. This is the retirement income cliff trap. And I am the only one in your feed willing to call it what it is. Welcome back to the archive. I am the retirement insurgent. And today we are tearing the roof off one of the most misunderstood retirement income rules in America. Because if you are married, if you are retired, or if retirement is even visible on your horizon, you need to understand exactly why so many couples discover this trap only after the damage has already been done. And by then, the notice has already arrived. The calculation has already happened, and the money is already gone. But before we go 1 inch further, I need you to do something. Smash the like button right now. I am not asking, I am telling. Because in 2026, retirement education competes against an endless stream of entertainment, politics, and distractions. And the people who need this information most often never see it. Your like helps break through that wall. It tells the algorithm that retirees deserve access to information that could save them thousands of dollars. So hit it now. Then subscribe, flip the bell, join the archive. Because what I am about to show you is something your Medicare handbook probably didn't explain clearly. Your retirement planner may never have discussed it, and many retirees don't learn it until the government sends them a notice they never expected. Now, the lawyers would like me to remind you that this is not financial advice. It is not tax advice. It is not legal advice. This is education. Every situation is different. Rules change, income levels vary, and you should always consult a qualified professional regarding your personal circumstances. But make no mistake, the concepts we are discussing today are very real. And understanding them could help you avoid a retirement surprise that catches thousands of married couples every year. By the end of this video, you are going to understand 3 things. First, the invisible Medicare income line that many couples accidentally cross. Second, why Medicare looks backward when calculating future costs. And third, several planning strategies that may help reduce the chances of expensive surprises later. Because once you understand the mechanism, you stop seeing retirement income the same way. Now let's get to work. Most retirees believe something that sounds completely reasonable. They believe that more retirement income is always better. More withdrawals, more gains, more income, more freedom. And in many cases that is true, but not always. Because there is a hidden layer sitting underneath retirement planning. A layer that many people never notice until they receive a notice in the mail. Look at the dirty legal trick they use. Medicare doesn't simply look at what you're earning today. Instead, Medicare often looks backward. Specifically, Medicare uses income information from prior tax years when determining whether certain premium adjustments may apply. That system is known as IRMAA, the Income-Related Monthly Adjustment Amount. And if you've never heard of it before, you are not alone. Millions of retirees have never heard the acronym, yet the costs associated with it can be very real. After studying Medicare premium regulations, IRS income reporting rules, and retirement planning examples across multiple states, the pattern is unmistakable. Retirees frequently focus on taxes, they focus on investments, they focus on Social Security, but they often overlook Medicare income thresholds entirely, and that oversight can become expensive. Let me do the math live so it lands. Meet Robert and Susan Walker, ages 71 and 69, Scottsdale, Arizona. Robert receives Social Security benefits. Susan receives Social Security benefits. Together, their Social Security income equals approximately $58,000 annually. Robert also receives a pension worth roughly $42,000. So far, their income looks manageable. Now add a retirement account withdrawal. They withdraw $95,000 from a traditional IRA. At this point, their total income reaches approximately $195,000, still below a key threshold. Then something happens. Their financial advisor suggests a Roth conversion. A perfectly legal strategy, potentially a smart strategy, but timing matters, amount matters, income matters. They convert $25,000. That pushes total income to roughly $220,000. Now look at the dirty math here. A $25,000 decision didn't just affect taxes, it potentially affected Medicare premiums as well. One decision, one transaction, one line on a tax return, and suddenly they may find themselves paying more than expected for Medicare coverage. This should make you absolutely furious, because the issue isn't that rules exist. The issue is that many retirees never understand the rules until after the income has already been reported. And here's the part that should put smoke out of your ears. Many people cross these thresholds accidentally. A property sale, a mutual fund distribution, a large IRA withdrawal, a Roth conversion, an inheritance-related transaction. Any one of those events can alter the income picture dramatically. And most retirees don't discover the consequences until much later, months later, sometimes years later, when the notice finally arrives, and they realize that a decision made in the past is now affecting costs in the future. This should make you absolutely furious, because retirement planning is supposed to create certainty. Yet for many couples, the system introduces complexity exactly where they expected simplicity. And believe me, we're only getting started, because once you understand who created these rules and why they exist, the entire picture changes. Oh, friends, it gets so much worse. Now let's answer the question nobody asks. Who designed this? Who looked at retirement income and decided that one extra dollar could sometimes create a completely different cost structure? Who built a system where retirees can make what appears to be a reasonable financial decision only to discover consequences much later? The answer is not some secret committee. It is not a conspiracy. It is Congress. It is federal policy. And it is the ongoing effort to fund one of the largest entitlement programs in American history. The income-related monthly adjustment amount did not appear by accident. Over time, lawmakers expanded income-based premium adjustments with a simple goal. Higher income beneficiaries would contribute more toward Medicare costs. That's the official explanation. And to be fair, there is logic behind it. But here's where things become frustrating. The thresholds are mechanical. They don't care why your income increased. They don't care whether the increase was temporary. They don't care whether you sold a property, completed a Roth conversion, or simply had an unusual tax year. The calculation happens, the threshold is crossed, and the adjustment can follow. The system is designed to use formulas, not context. And that's where many retirees get blindsided. Because retirement isn't lived on a spreadsheet. Retirement is lived in real life. Real life includes emergencies. Real life includes home sales. Real life includes estate settlements. Real life includes helping family members. But the formula doesn't see those stories. The formula only sees numbers. This should make you absolutely furious. Because most people spend decades learning how to save money. Very few spend decades learning how retirement income is measured. And that's exactly why so many couples are surprised. Who benefits? First, Medicare financing systems benefit because higher income beneficiaries contribute more. Second, federal revenue collections benefit because more income is being reported and taxed. Third, Long-term program funding structures benefit because additional resources flow into the system. Who loses? The retiree who never knew the rule existed. The couple that made a perfectly reasonable financial decision without understanding. Let me show you two couples. Same city, same retirement, same assets, same financial goals, but two completely different outcomes. Watch closely, because this is where the lesson becomes real. James and Linda Cooper, Type A. No planning, no income forecasting, no threshold monitoring, no coordination between withdrawals and Medicare rules. They retire with $1 million in traditional IRAs, $250,000 in a brokerage account, $80,000 in cash savings. A few years into retirement, they decide to simplify their finances. Their advisor recommends a large IRA withdrawal and a substantial Roth conversion in the same tax year. The decision seems logical. The paperwork gets signed, the income gets reported, the tax return gets filed, and everyone moves on. Then comes the surprise. The higher reported income affects future Medicare premiums. Additional costs begin showing up, year after year. Money leaves their retirement plan that never needed to leave. Not because they broke a rule, because they never understood the rule. Now let's look at Type B. Same couple, same assets, same retirement goals. But one major difference: planning. Before making any large withdrawal decisions, they review their projected income. They look at upcoming Medicare thresholds. They evaluate multiple withdrawal scenarios. They spread taxable events across several years. Instead of creating one giant income spike, they create a series of smaller, more manageable decisions. The result? They may still pay taxes. They may still pay Medicare premiums. But they dramatically reduce the likelihood of triggering avoidable cost increases. The difference over several years? Potentially thousands of dollars. Same retirement, same accounts, same couple, different planning process. Thousands of dollars apart. That is the entire game. Because retirement success isn't always about earning more. Sometimes it's about keeping more. And those are two very different skills. Doc, save this video right now. This is your survival manual. Because information only helps you if you can find it when you need it. When that tax planning meeting arrives, when that Medicare notice arrives, when that withdrawal decision arrives. You want this checklist available, not buried somewhere in your watch history. Now, here is what you are going to do tonight. Not next month, not after the holidays, tonight. Step 1. Pull out your most recent federal tax return. Look specifically at your adjusted gross income. Then compare that number against current Medicare IRMAA income thresholds. Many retirees have never done this. Start there. Step 2. Create a simple list of every income source expected next year. Include Social Security, pension income, IRRA withdrawals, capital gains, rental income, Roth conversions, everything. You cannot manage what you cannot see. Step 3. Write down any major financial event you expect within the next 2 years. Selling a house, selling investments, large distributions, business income, inheritance-related transactions, anything that could significantly change taxable income. Because surprises become expensive when they appear on tax returns. Step 4. Schedule a planning session with a qualified retirement tax professional, not a product salesperson, not someone trying to sell an annuity before understanding your situation, someone who understands Medicare income planning, someone who understands retirement distribution strategies, someone who understands how all these moving parts interact. The Medicare system already started its clock. You need to start yours. Every year you delay understanding these rules is another year you risk walking into a threshold you never knew existed. Tell me in the comments. Which step are you starting first? And what state are you retiring in? We learn from each other. We build this archive together. And if you know another married couple approaching retirement, send them this video. Not tomorrow, today. One conversation now could save them thousands later. You can be surprised by retirement rules, or you can prepare for them. The choice is yours. You can wait until a notice arrives, or you can learn how the system works before the notice ever appears. You can discover the trap after it costs you money, or you can understand the trap while you still have options. That's what this channel is about. Not fear, preparation, not panic, knowledge. Because the retirees who usually come out ahead are not the smartest. They are not the wealthiest. They are not the luckiest. They are simply the ones who understand the rules before they make major decisions. And that advantage compounds over time. Smash that like button one more time on your way out. Help this video reach the retirees who still believe retirement income is only about taxes. Because as you've seen today, Medicare often has a vote too. Subscribe, turn on all notifications, join the archive. Because in our next video, we are exposing one of the most overlooked retirement planning risks in America, the widow's tax penalty. A hidden rule that can dramatically change the financial reality of surviving spouses. You do not want to miss that one. I am the retirement insurgent, This was the archive. The trap was built for the retiree who does not know it exists. Now you know. Act accordingly.